All right. So, just to get going here, as always, I just want to share a few things about today's webinar and also introduce my guest today on this special webinar we've got planned for you today. There's a lot of thought, and people, there's our team has put into who comes on these webinars, why, what people are talking about, and what the market's talking about as well. It's the market's interesting, especially real estate, right? I mean, the real estate. I remember a year ago, everyone was talking about, next year, 2026, that real estate, it's rates are going to drop back to 2 or 3%. And now it's funny. Now I hear people's conversations like, all right, well, next year, 2027, that's when we're going to see it, and that's when we're going to feel it. And look, if I played that game, I think I'd always lose. I don't wait. It's not just about interest rates. It's also about right people, right organizations, right asset class. And so today we're going to talk about that a bit. And so welcome everybody again. I wanted to just share a few things as we get started. First, housekeeping. I'll mention this probably a few other times as well. I'm not a financial advisor or an attorney or a CPA, nor is Andrew or Derek. And so please take this information as really educational. And yes, we do see these things. I would say I am an expert in the self-directed IRA space, not necessarily in the tax space for you and your personal tax returns. I don't know those. That being said, today's content I know is going to be helpful for all of you, even if you have heard from me before. You most likely have not heard from Andrew and Derek. So the other thing, we are going to do what we've done in the past because we've enjoyed it so much. We are going to give out at the end of today a $100 gift card for the most active participants in the chat, and you know what those are: the emojis, the high fives, and or questions, and the questions and answer. Please put your questions as well in the question and answer box because we will get to those towards the end as well. So most active in the emojis, hit them for us, and we'll use AI to tell us who is the most active. Um, and I think that's about it. Before I get started, I'm going to take the first 20 minutes here and then pass the baton here to Andrew and Derek. But let me just start by saying, look, I'll lead with the first thing that I said when I met these guys is, you live in Chicago. This is my hometown, and so I want to hear more about you. And I was introduced to these guys through basically a couple individuals that have worked with us at Horizon Trust Company for a while. And they're like, you got to meet Andrew and Derek. And I was like, I don't know, everyone kind of, a lot of people like to talk to us at Horizon Trust Company and or want to, do a podcast or whatnot. And I was like, all right, from Chicago, I'll hear them out. And then what they had was so unique. And so what they're going to share with you today, kind of in the workspace, I'm not going to take it away kind of from what they do and how they do it. But if you've ever wondered how to be involved in it, interesting in how they've found a problem and a solution, and wanted to get involved in something in a bigger scale, not necessarily a big fund, which I think is unique. I feel like a lot of the people that educate and talk about their different products and services, it's these big, massive funds where, they're raising 5, 10, 20, $50 million. One thing that's really unique about what they've got and what they're showing and what they're going to educate on, this is a purely education here today. We want to make sure you understand, is on a smaller scale. And when I say small scale, like you're able to be involved in a bigger project, but with, smaller dollars and not have to be one of 100 or one of 200 investors. And that kind of is appealing and sexy in its own. So, uh, from Chicago, vertically integrated in the real estate platform. Just a great team and great to work with. Andrew, I know, came from Blackstone. I mean, they've worked with billions of dollars in real estate. I know they used to do 50 or 60 properties, I think, a month, right? And I don't know how you did that. I mean, I know it takes team and a system, but what you have now and how you do it, now you're on your ninth project, I think, or ninth or 10th project. Very impressive. And they solve a big need in today's workspace area. So without further ado, and before I get going, let me introduce Derek and Andrew here today from Brick and Mortar.
Perfect. Thank you, Greg. Derek, do you want to kick off or you want me
Go
to?
ahead, take the floor.
All right. Uh, yeah. We're very grateful to be here today. Thank you, Greg, for giving us the opportunity to share. And yeah, we're looking forward to educating and diving into all the details. You're gonna jump in first, Greg, and then we'll
Yeah,
go.
I'll jump in first. Like, so Andrew and Derek, these guys, uh, they've got a system and an operation that is very tight and very interesting. And I know you're going to learn a lot from these guys. And so I know they've got some slides they want to share before. So I'm going to kind of lay a foundation here, especially for those that are new and those that are not new. It's a good refresher. Um, Tell me if you can see view slideshow, or can you guys see my continue to share? Can you guys see my presentation? Are we good? I hope so. Technology scares me. Um, so, anyways, we're going to talk about some of the fundamental things. So, first and foremost, if you are new to us, just I want to just clarify who this message applies to that I'm sharing with today. If you have a retirement account, an old 401k, an IRA, a SEP, a simple IRA, a Roth IRA, an HSA. If you have one of these types of IRAs or an old 401k from a previous employer, what I'm about to share with you today, and also what Derek and Andrew are about to share with you today, applies and applicable to you. If you don't have one of those type of accounts, it still could apply to you. You might have access, a spouse or family member might have one of these type of retirement accounts, or you could most likely create one as well, like my son has. And so that's who I just want to be real clear. You definitely want to hear this, trying to become a more strategic investor and really maximizing your returns. So I already shared the disclosures. I am who I am, start of Horizon Trust Company, not a financial advisor. This is the strategy that most people, maybe even yourself, have looked, kind of taken on when they go to save their money in the retirement account. You have this hope and pray retirement. You're buying into the stock HAP, baby. If you just keep putting money away at the time that you keep doing it, you're going to end up hoping and praying. And 10 years from now, or 20 years from now, when you go to retire, that the amount of money you have in there is enough to cover your retirement years. This strategy is out of date. This does not work anymore. And so it's really important that people take more initiative and more time and energy to focus on what they're going to retire. I mean, what they're going to invest in. I see this all the time. I'll have people raise their hand and say, okay, who here in the room in the last 30 days, back before COVID, right? When I used to only do pretty much live events. Now I feel like they're mostly webinars and podcasts. But I'd say put your hand up in there if you have in the last 30 or even 90 days talked about and planned a vacation. Every hand's up. And then I say, okay, keep your hand up for the last 30 days or even 90. If you've taken 30 to 60 minutes looking at how you're investing and what your retirement plan options are, over half the room goes down. It's just something people, it's not near as sexy as talking about Cabo. And I don't know if Mexico is the right thing to say right now, or Europe, or wherever the case. That might be sexy to say right now. Florida, maybe that's the vacation spot. But you get what I'm saying is people just aren't spending the time, but they want the results. So they want to be able to retire in the sunset and have all these things, but not put in any time and energy. I hope and we hope that you take a little bit of energy, 30 minutes a month, into taking action and looking at how you invest. What is your biggest expense? Taxes. We are all going to spend somewhere between 40 and 60% of every dollar we make on taxes. So if we can learn how to eliminate, probably not eliminate, but decrease and pay less in taxes, this alone will help us better prepare us for retirement. And so the taxes aren't going away. So we all have a common problem, right? With our common problem is one of our biggest expenses, which is taxes. So who controls? Let's start talking about retirement. We have a kind of, most people have a control problem, and that control happens to be where you are investing and where you're looking to invest your money. We let other people, when I say HAP, hope and pray, most of us let other people just invest the money how they want. Oh, on a scale of 1 to 10, I want you to invest my money at a 6 or 7. Well, guess what? Your advisors, or most people, I'm not here to hate on all advisors by any means, but they get paid regardless. The market goes up, the market goes down. No one cares more about your money than you do. Not me. I don't care more about your money than you do. You care about your money more. And most advisors go the same way. And there's nothing wrong with that, with the exception of if you're looking for making a little better returns, you should take a little more action in directing where your money goes. Now, in today's world, there's over 105 million retirement accounts. Today in the United States, over 105 million. That's over 40% of adult Americans have retirement accounts. This number is over $22 trillion inside of those accounts. So when I started this presentation and I said, hey, look, there is, who qualifies here to listen and, excuse me, to understand what we're going to talk about today. Most people don't understand or even realize that you're part of this 105 million. Most likely, at least 40% of you, probably in this call, maybe closer to 80% of you are part of this 105 million. If you aren't, your spouse is, or your child is, or your parent is. So this is incredibly applicable to you in your life today. I remember when I started 23 years ago and did my first real estate deal, I did not have one of these retirement accounts. But I learned this concept, as many of you might have heard of me share before. And I had an individual that was able to partner with me with their IRA to do my first deal. And so if you don't have one of these accounts, most likely someone around you does have one of these types of accounts. And so the typical retirement system was built, by Wall Street guys, right? And gals, right? They had limited investment options, employer controlled plans, didn't get to see the fee structures. I think most people still think if they're with, TD Ameritrade or someone else like very low fee, like, oh, I'm paying $25 a trade or 1%. Most people understand that inside of all those mutual funds and indexes are much more fees, 1 to 3% per year. So the people that have created the system that are advising, they're making money. And there's nothing wrong with that, by the way. But it might not be. I mean, if you think about that, 1 to 3% over time is a huge difference. Now, what if you could save some of those fees? What if you could direct your money and put them in not just a typical Wall Street type of options, right? What if you could? Well, we know you can. That's why a lot of you are on here today. The typical 401k or typical retirement account versus self-directed IRA account. Typical is you have a limited menu option, right? If you go to your advisor and like, hey, look, I want to invest in XYZ new business or real estate, you can't do it. It's not an option. You've got to go from their menu. It's controlled sometimes just by the employer if it's your 401k plan. And it's just a paper investment. When you self-direct, what's unique and what's exciting, at least to me, is you're able to go into all kinds of different alternative assets, into real hard assets. Stock versus rock, I like to share. You can be on the stock on paper, which by the way, I still do. So I'm not here to say that you should take all of your money and all of your retirement funds out from a Fidelity or Charles Schwab and put it in rocks. I call rocks real estate, right? Or some kind of hard asset. But what you can do is start making little tweaks and seeing what can perform better year after year, what's more consistent. Getting rid of or trying to eliminate the big volatilities in your retirement accounts is really the best way of creating real gains and preparing for retirement. Getting rid of the volatility or limiting how low and not how high, right? But how low it goes in the lows. And so understanding your retirement accounts, but also starting to invest in alternative assets inside of your IRA. Now, most people, when they see different opportunities and educate themselves, like Andrew and Derek, they got investors that invest with them and a lot of other investment classes. They'll invest outside of their LLC. And so they invest in it, let's say in a deal, in a hard asset. And then when it pays off, exits, they pay the taxes on those returns. When you do it with inside your IRA, obviously you're deferring and not paying taxes potentially forever. Now, we just talked about this. Volatility isn't the risk, it's a lack of control. Having control of your retirement account. I would also say, the volatility, I might even change the slide for next time, is part of the risk. The more volatility you have in your investing is risky, but being able to control the volatility, I think, is the most powerful. So I think this is also where some people might get confused as far as retirement accounts. They're not necessarily investments. I think some people are like, oh, look, I want to invest in my self-directed IRA. Well, that's great. You want to open up a self-directed IRA to invest in real estate or in cryptocurrency or in businesses. Well, sure, but that's just the container. That's not the actual investment choice. So you create the container and or account and or transfer into that type of account, and then you can start investing in the investment of your choice. And so, moving on here, I think this is one of the bigger subjects that people always ask us about, and if they don't ask us, they should be asking us about, which is the difference between the traditional and Roth. And for most of you, you probably understand this traditional over Roth. The bigger question comes into play is how can you transition your self-directed traditional account into a self-directed Roth account? The quicker you can get it into Roth, so that way all of your gains in the Roth that continue to grow will grow tax-free and then come out tax-free without any required minimum distributions. Now, I know this could be some new terminology for those that are listening here. And don't worry, our team will hold your hand through the process to educate you for subject matter that you might have some more questions on, or please put it in the question answer. But understanding the self-directed IRA is one thing. And that's what we do at Horizon Trust Company is we help individuals get their retirement accounts or some of them, or some portion of them, transferred over tax-free into an account that allows you, call it a container, into a new container, an account where you are able then to invest in asset classes that are unique, that are different, that might be a little bit more hands-on, or more friendly, or more understandable, or bigger returns. That's the goal. That's our goal at Horizon Trust Company, is to help you create the container so then you can take action. Now, if you need to change the container, I'll keep using that because of my previous slide, from traditional to Roth, that is the quicker you can do that, and we'll talk about that actually tomorrow. Tomorrow, I'm going to share with you why that's important. But really, the quicker you can get it to a Roth, the better. And we help you at that at Horizon Trust Company. So, when there's and this is something I'll spend a little more time on tomorrow as well, because I really want people to dive more into the importance of a self-directed IRA. But that being said, if you choose an IRA and you can't qualify for a solo K is something that is for an individual who owns a business. If you own a business, which you can have a W-2 employment, but then also create a business with an LLC, like you want to start a real estate business or a passive real estate investment business, you can create a solo K. We can help you do that at Horizon Trust Company, and then you're able to contribute much more. That's one of the things people ask us all the time is I'd like to put more money in my retirement account, but there's limitations. My IRA only lets me do $7,000 or $8,000 or $20,000 if a simpler SEP. We at Horizon Trust Company can help you, educate you on what's the right type of container or retirement account for you. Then you can go back to your CPA and consult with them and make sure the education you get from us is the right fit for you. And so we have lots of individuals like, hey, look, I really want to contribute 40, 50, 60, $70,000 per year. And I want to actually try to get it into a Roth account. We can show you how to do that. I don't know if you just heard what I said. Most people think and believe that they can only put up their minimum into a Roth of $7,000, $8,000, or they make too much money to contribute to a Roth. All could be true, but potentially, if you have a business and you pay yourself compensation for that business, there's the potential between employer and employee matching to put up 50, 60, 70,000 per year in an annual contribution every year into your retirement account. This really changes the way you retire. So this retirement account, self-directed, really is just an IRS approved account. If, for example, if you already have a traditional or simple IRA or Roth, it still is a simple traditional Roth when it moves over to us at Horizon Trust Company. That does not change. It is still that, but it's self-directed. This has been around since the 70s, for over 50 years, since 74. This has been around. This is not a new concept, but amazingly enough, only 5% of Americans do this because most people just don't know or don't have the mindset. So when you decide that you want to self-direct, there's different options. There's all kinds of different options. I would say 70% of our clients are investing in some kind of real estate. Now, I probably could have a whole real estate slide. I could fill each one of these circles up with different kinds of syndications and deals and workspace deals that we're going to talk about a little bit today, and notes, etc. This is a small small scenario of what people can invest in. I would say 75% of people invest in real estate. The other 25% are investing in crypto, precious metals, and different businesses as well. Um, I wanted to give this example. I feel like this is probably one of the most powerful things. And again, this is hypothetical, and I know this is a 20% rate of return. You can plug in using all kinds of compounding calculators, 10%, 8%, 12, or 20. I want to put this in just to give you the example of compounding versus non-compounding. If you were to put in $100,000 from your IRA, let's say it's a Roth, you convert it to a Roth IRA, and you're making on average 20% in your money. After 15 years of not adding one new dollar of contributions, just compounding on your profits, you'd have 1.5 million over 15 years. Now, I'll go back to that, but the power of compounding of right here. If let's say I put $100,000 in an example, I invest with Andrew and Derek, and they give me these returns, but I do it through my LLC or through myself personally, not through my IRA. Look at the difference. Well, after 15 years, just by using an IRA container, the self-directed container, it's a $600,000 difference. Not investing in anything different, just by using a vehicle that the IRS approved over 50 years ago. So when you see or when there's opportunities to make greater returns and you want to avoid the number one expense in our life, which is taxes, using this vehicle is powerful. $600,000 in this example. I've played with all these numbers. I've done it based on 10%. It works every single time. Instead of saving 600,000, it only saved you 150 to 250,000. Is it worth it? Saving 150 to $250,000. Well, I can tell you the math on that. An extra $200,000 in your retirement account when you go to retire at a 10% or 8% rate of return, that's $15,000 to $20,000 of additional interest income that goes to you when you retire. Per month, that's $1,500. That's a rent payment, that's a vacation, that's a car payment, depending upon where you live. It could be all of your expenses. If you live in Ecuador. um, so, making these little tweaks, these little changes in how you invest and using your retirement funds is a complete game changer. So, as I kind of wrap up here, I want to just share a couple of different things. I want to introduce, I want to turn the time over here to Andrew and Derek. But that being said, there's different types of investors. Now, there's the basic self-directing investor that's kind of moving from more passive to being more aware. So, right, so you might have an IRA or an old 401k. You're limited in your traditional investments or just whatever your employer says. You're getting average returns. Who then opens up a self-directed IRA, who learns what's allowed, who might invest in one deal a year. This is where most people begin, and there's nothing wrong with this. This level one is really like a few steps ahead of the average American investing using their retirement accounts. This level alone is years ahead or levels ahead of the average investor that is just investing in HAP. So this is where I'd say most of our investors begin. I would say 70% of our investors move over their retirement account and invest in a deal, one or two a year, get their feet wet, start understanding it. And then as you move on, the next characteristic, people that are using the IRA, not just the container, but they're starting to get into more syndications. They might be doing some more lending. They're flipping, they're turning and churning their money a little bit more often, maybe a couple times a year. That's a level two. And so you're being more intentional than just kind of investing in a deal and then waiting for it to pay off in a year or two, and so on and so forth. Number three, I see a lot of people doing this. Now they're using their retirement account, but also using bonus depreciation and a lot of different tax optimization techniques to convert their money from a traditional to a Roth. And they start planning more on their multi-generational planning. You just don't have to, like I said at the bottom, invest randomly. You can allocate capital with precision. And the thing I like to share about this is anyone can do this, and you can do it on a small scale. You can invest in a deal. Let's say you got a 500,000 IRA. You can leave $400,000 at Fidelity. This is where I kind of began, and I was like, all right. When I started saving money, I had some self-directed money, and I had some money with an advisor. And I'd enjoy kind of playing that game, meeting with them once a year. Like, hey, I'm beating you. Like, I need you to beat me. Like, this is what you do all day. And we'd have those, and the typical answer as any financial advice, hey, this is the long game. It's a marathon, right? It's not a sprint. And I'd be like, okay, after 5 years, I'm like, what the F? Like, come on. Like it's been 5 years. I mean, and I know a marathon's longer maybe than 5 years, but not in my world. And so that's when I started transitioning and doing more in the self-directed space for me personally. But I'm also still in the market. This is absolutely not for everybody. This is for those individuals that want to take a little more action, understand where they're investing. Those are a couple types of investments. And so as I transition here over to Derek and Andrew, I just wanted to share. Look, if you're on here and you have a retirement account, any kind of retirement account, and you're worried about the hope and pray strategy, it's okay. You're not alone, but we can help you with that. And we want to help you. We definitely want to help you and educate you and lead you and guide you through the process of how a self-directed IRA account can work for you and your account. And then for those that are really looking to kind of invest and learn and execute on different types of asset classes, you're not going to want to really miss tomorrow. So tomorrow we're going to dive deeper into, I'm only going to spend probably about 15 minutes tomorrow. And then you're going to hear a bit more from Andrew and Derek, and then we're going to leave a lot of time for question and answer. But we really want to answer questions specifically about how to be more tactical with your self-directed IRA, how to really avoid the expenses that might be in your life, how to, if you're paying taxes on too many of your gains, how do we change that or avoid that? How do we convert to a Roth? How do you get into an asset class, but without being an operator and understanding what you should be asking for and keeping other people accountable to do the work for you, which is what I love doing as a self-directed IRA investor. So let me. I'm going to get out of here, stop my share, and as I transition over here, I just wanted to share as well. Look, stay. I wasn't looking at question and answers here. I think there's already a handful we'll go to towards the end. Keep on your emojis and chats and etc. But I will share with you for those of you that are listening and want to or watching us. For those that are looking to take action here at the end, we're going to give you some more information on how to um, look at your retirement account and how this is applicable to you. And specifically, after hearing and getting educated here by Andrew and Derek, I think you might be able to kind of put some of these pieces together, because that's usually one of the other questions that people ask us is, okay, so what do I do now? I like to self-direct, but what are my next steps? How do I take action and execute and be precise in my investing? So all that being said, I'm really excited here today. This is something I think most of you have not, you might have heard of it, but I just don't think most of you have probably even applied it. And it is such an opportunity, especially after COVID. And that's changed, I think, this whole workspace in general. And so without, taking over any part of your presentation, thank you, Derek and Andrew, for being here. I'll let you take over here before we go to some questions and answers, but please keep chatting and asking questions, everybody.
Well, Greg, thanks for all the information. And I just wanted to say congrats to each and every one of you guys for taking out the time to be on today. And like Greg was just highlighting, like actually taking ownership at a higher level of your financial future. I am a big proponent of that, as he mentioned, and I won't, go back over, but some of those programs and ways of doing things you don't feel super in control. And so I'll just share a quick story. I actually started investing with Andrew and brick and mortar as an investor. So I was in your seat a few years ago. And I had built an e-commerce business, had scaled it up to a few million. I was teaching and training other entrepreneurs how to do the same thing in multiple countries, speaking on stages from, a couple hundred to whole stadiums right around the globe, and it got to a point where I did have extra income. And so I was like, man, what do I do? And so I was looking at things, and I actually had an old retirement account that my wife had from work. And Andrew was expanding, and I just said, man, like I'd like to get involved. I could use cash, or I could cash this out. And so I wish I had met you, Greg, years ago, because I cashed it out, took the hit, probably lost close to a fifth of the money in there. And am I glad I did it? Yeah, I wouldn't look back. But man, I wish I had kept that fifth, and it was, growing and compounding and going to work for me versus just going to the IRS. And so I love the program you have here, Greg, and I love what you're sharing. And I think there's a lot of smart people on here that are going to see the benefits of that. I will say I started investing with Andrew, and now I've come aboard as a partner and helping grow and scale things, investor relations to new projects and new assets that we're expanding into. And so, really excited to share with you guys. We're hitting a really exciting phase of momentum, and I think you're really going to like what you have to hear. So, I'll let Andrew kind of take the floor a little bit here, but I'll interject a few things along the way. But I would just encourage you, don't make the mistake I make. Get with these guys at Horizon Trust, get with Greg and his team, and learn about how these programs work and see how they might benefit you in your financial goals.
Thanks, Derek. Appreciate it. And again, thanks, Greg. I used to be in the crowd, and so this is a bit of a surreal moment here. Now I get to present, so this is neat. So without further ado, we'll run through this, and I'll do this at. Let me just share my screen here. You guys see that? Everything look good?
Yep.
Perfect. All right. So, Brick and Mortar was born in 2019, and so Brick and Mortar was born out of the fact that myself and our business partner Adam, uh, we both had been working out of co-working spaces, and so curious how many people have worked out of a co-working space. So feel free to enter that into the comments if you've worked at one and which one you've worked at. Yeah, we had always worked out of co-working spaces since 2014, and I'm not Mr. Co-working. I thought it was strange, odd. Thought people were going to steal our ideas, and thought it was just going to be an interesting setup. And Adam said he had worked out of 1871, which is a tech co-working space. Adam's got a background in early stage tech companies. I have a background in, as Greg mentioned, I work for Blackstone's Invitation Homes. We're fortunate. I was one of the first four people brought on there. We're purchasing 50 to 60 homes on a weekly basis. And then we ramped that up into construction, leasing, and management. So got to see an entirely vertically integrated system done with the big boys. And that was fun and exciting, and learned a ton. Uh, Brick and mortar, so transitioned, had a tech-enabled property management company that we were Adam and I were running. We had always worked out of co-working. We developed a construction company, and had moved from I don't know how many people are from Chicagoland, but moved from Chicago to a suburb just outside of O'Hare called Park Ridge. So if you've been to or heard of Park Ridge, feel free to comment. It's a great suburb. And so I moved out there. Adam, he followed it as this was 2017 and 2018. So we moved our families out there. And then we were commuting. And for those of you not from Chicago, we were literally commuting 13 miles. And that could take anywhere from 45 minutes to 2 hours in traffic. And so one of those early mornings, commuting downtown to our then office in the West Loop, literally Adam and I were on the phone and said, man, this is nuts. We're commuting cumulatively probably about 80 hours a month. And we'd be doing anything that we'd prefer, sleeping, spending time with family, working out, whatever it might be. And so why don't we move our office? And so more of a passion project for us. We moved our office. We were looking at moving our office to Park Ridge. And for us, we'd always worked out of co-working spaces, shared office spaces. And here's what we learned is that the infrastructure for the way we wanted to work, it just didn't exist. Pardon me. There we go. And so we looked for co-working, and what we found was a lot of outdated office. And then we found that we did some more research and a little bit of digging, and we found that there's about three coffee shops around where we live, and people were working out there. So it's two Starbucks, one independent coffee shop. People were trying to work out of the library, even the gym. So there's an FFC by us that people were working out of. And we realized that people could use a co-working space. And so co-working is just that. It's a shared office, right? So it's the opportunity to work near home, but not at your home. And so we acquired our first property in 2019. It was in Park Ridge, and it's actually the oldest building in Park Ridge, built in 1865. And so it was just sitting on the market. There's a distress in the marketplace between 5 to 10,000 square feet, and because restaurants are downsizing, retail's downsizing, and so we saw this opportunity to transition that type of real estate into co-working. So we'll go through here. Co-working being the opportunity to be able to work and have fractional type office where you have an amazing home court advantage, but you don't own all of it, and it's on a membership basis. So it's hourly, daily, and monthly office. This shows here that the number of people working on site at the office has remained around 20% since the pandemic. So you'll actually hear uh, probably in the news, you've heard that everyone's going back to the office, the push to return to the office. And that's simply not true. Actually, one of our incredible advisors, her name is Julie. She's been working with Chase for quite a while and done a great job there at their HQ. And so Julie actually is one of our advisors, and she said, you're going to hear this from the top, but ultimately we don't even have the space to get everyone back to the office, and we can't. And then if we're trying to force people back to the office, we might lose them. And so she said, I love what you guys are doing because you're catering not to the Fortune 500, but to the individual. She said, everyone is pretty much your customer. And if you want to think of these spaces, these become a rec center, similar to how a rec center is that hub for the neighborhood when people want to work out or be active. Uh, Brick and mortar is the business hub for the neighborhood. And so these are tech-enabled, on-demand workspaces. And so literally we have an employees that can give tours, but you sign up online and our customers are able to enter and access based on whatever services they want. So I'll run through the proof of concept. This has been Park Ridge. It was previously a very dark Italian restaurant. I'll actually be sharing some before and afters tomorrow. So you'll definitely want to check out tomorrow. We'll share some before and afters of the construction. But this is our proof of concept. So we acquired the real estate. We repositioned it into hospitality-driven co-working. And then we have 100% occupancy on the offices and then a significant member retention. And at the end of the day, here's how this works: is that we're acquiring real estate, doing the construction, and then filling it, right? So driving up the occupancy and creating a successful business called brick and mortar. And then we're able to refinance the real estate and with the business inside it to create significant returns for our investors. And so the returns here, cash out refinance proceeds were north of 600,000, which ultimately translated into all of the investors. So here's how it works, right? So the investors receive an 8% pref along the way. And then the cash out refinance event returns all of the investors' principal plus profit. And then we're huge proponents in creating generational wealth. And so our investors get to participate in perpetuity on a pro rata basis, which means that forever, as long as these are going, which we certainly believe that long term, people are going to have their Netflix membership, they'll have their gym membership, and they'll have their co-working membership. You investors, you will be able to participate in an ongoing basis. And so
Sorry, I'm
just
going to interrupt you there. I'm
yep,
gonna interrupt- so
yeah,
that would mean essentially like once you refinance, the risk is off the table. So if it doesn't work in perpetuity, the risk has been taken off, the returns have happened. But if it does, it just is like an annuity that just keeps on paying. Is that correct?
that's exactly right.
Yeah.
Yeah, we like to coin it as infinite returns because you got no money in and you get to earn indefinitely,
Hmm.
which is a pretty exciting position to be in. And so that's what we were able to achieve here in Park Ridge. And then from there, we said, and again, remember for us, we were just simply looking for a better place to work and to bring our construction company to. And we said, from there, why don't we start and explore where else we could do this throughout Chicagoland. And Chicagoland has a ton of incredible neighborhoods. And so we made a list of about 35 to 40 neighborhoods, and we started going out and doing this. And so we started going, we have our second location in Deerfield, our third location opened in Glen Ellen, and then our fourth location opened in Libertyville, we're opening our fifth location in Arlington Heights, where hopefully the Bears are moving to in the next week. Not the Bears. We're opening next week in our
Bears don't know what they're
in
doing yet.
yeah, that's a fact. So we're opening in Arlington Heights in a week, and then we have three more that are under construction. And I'm going to quickly just show you what we're going to chat more about tomorrow. Uh, here's our,
So
yeah,
one more
please.
interrupt. Sorry, Andrew.
You're good.
You've got you've got 4 or 5 already completed,
Hmm.
and 3 underway. Correct? Is
That's
that
accurate.
correct? Okay. All
That's
right.
right. Hmm.
So it's not just it's not hypothetical. You've been doing these and you've got them, actively operating and on over 5. That's cool.
That's right. So anyone here, if you're near Chicagoland, wanted to even test it out, you could literally go on the brick and mortar website, yourbrickandmortar.com, and you can see how it all works, right? So you can purchase a day pass for $35 and then work from this beautiful space for the day. You could purchase 1 hour in the conference room, which right here with the garage door, that's the conference room. You can purchase 1 hour, you can purchase 12 hours. And so what we find is that uh, as corporate is downsizing, the gig economy is growing. People are utilizing these spaces on an on-demand basis. Yep. And so they're working all over Chicagoland, and so that's why we're growing here into our next location, which is in Lakeview, so Chicago. So from a demographics perspective, uh, Park Ridge is about 4,000 people per square mile. Lakeview is north of 20,000 people per square mile. So what
Wow.
we believe is that our ramp up period, right, the time to fill the space is going to significantly decrease, and our revenue out of the gates will significantly increase. Though we are not basing our projections and pro forma off of that, we're conservatively utilizing our existing data to date. So Lakeview's incredible. It's an 8,700 square foot building. It's just south of Whole Foods. There's multiple Starbucks around this location, and so our raise that we're raising is 1,050,000, and that goes towards down payment, clothing costs, construction, working capital, and real estate acquisition. And so that's the raise. Again, it's an 8% pref, meaning that you're going to receive upon investment, you start to receive 8% on your investment. And then you get to participate and have ownership in that location, 50% ownership of the real estate, 50% ownership of the operating business, and then you're participating through the cash out refinance and then indefinitely from there. And so this highlights our limited partner returns. So you'll see the cash on cash. So uh, year one, we're going through construction and opening. Year two, we're opening, and so now the business is open and growing. Your year one, 8% is accruing. Year two, portion of your 8% is accruing, and then year three, you're receiving a 10% cash on cash return. Year four is the cash out refinance event. So now you have all of your money back plus profit, and then this highlights an IRR of about 25%. Again, this is utilizing our conservative figures that we utilized at the onset of our Park Ridge location. We outperform them, but we like to be conservative versus not. Equity multiple means that you're going to receive your money back 4 times on this investment. And so there's a quick $100,000. If you were to, an example $100,000 investment, if you were to invest 100,000, this is what those returns would look like. So an average annual income over a 10-year period of just close to $30,000. 10-year terminal earnings of 321,000. And then this highlights the pro forma, and certainly happy to run through any questions that might arise from this. And then here's our combined team. We need to get Derek in the photo. What's important here is whether you decide to invest with us or anyone else, I highly recommend doing it in a vertically integrated platform, meaning that the company or the platform or the people that you're going to be working with, if it's in real estate, that they have controls in place, that they handle their in-house acquisition, in-house construction, in-house leasing or business operations, and management. All of that in-house provides significantly decreased risk for the investors and greater controls for the operators, and ultimately should yield much better returns for the investors. And there's our advisor. There's Julie, who I was mentioning. And so there's our advisory board and the group that we've been working with and has been helping us guide this from literally a passion project where we were just looking to enjoy meeting people in the community to now we're getting close to, this is our ninth, and getting close to our 10th location. So thank you, Greg, for giving me the opportunity to share. Happy to answer any questions. And again, we'll have quite a few before and after photos tomorrow to share and walk through more of the details and inner workings on how this comes together.
Thanks, Andrew and Derek. So a couple things, and there's a lot of questions in our comments. Look, this is a snippet of the information I know that they have, also that we have at Horizon. So we can, fill in the gaps where it's like, okay, does that make, how does that really work? And so definitely schedule an appointment. You're welcome to do that with our teams. You'll see in the chat as well, because I know after tomorrow, especially as calendars are going to get full, and so we'll put our contact information here in the chat and schedule appointment with Andrew, and I think Courtney is on there. So Courtney, and also with our team. But that being said, just I want a question for me is, so like on this next deal you're doing, so when someone invests, it's in that deal, so it's not like in a fund where it's all the deals. It's deal specific, correct?
That's correct. Yeah, the
Yeah,
investors will have ownership of that location's real estate and that location's operating company.
got it. Okay, great. Well, let's if I want to, there's a lot of good questions that have come in, and so I'm going to actually bring Claudia in here as well as we spend the last 10 minutes here. We want to, so tomorrow again, we've got we're going to dive deeper into this kind of strategic stuff of being more precise on the retirement planning, but also they're going to dive deeper on the specifics. I know he quickly showed that pro forma. I assume tomorrow we'll kind of dive deeper into some of those details, how it works, and answering any questions we don't answer today. We're definitely going to grab a couple of the questions now, because I see some consistent ones that came through. But again, a couple, we're also going to give away a gift here in a minute for all those that were chatting throughout. We're going to give away a gift on that, and then our contact information is here too. So again, if you have an IRA or an old 401k, and you think you might want to see if there's a fit for you to invest and use those funds that in that container into an investment class that you want and choose, schedule an appointment. Our link's in there. Schedule an appointment or email us and just say, hey, I'd like to schedule an appointment. It's a very simple call. There's definitely no push. We want to educate you and make sure you understand. For those of you also like, hey, look, I already have a retirement account with the Horizon Trust Company. Don't need to talk to Horizon right now. That's fine. We still don't mind the phone call or schedule an appointment just to say hello. But if you want to skip that step and just schedule here with Courtney, that will get you with Andrew and Derek. Feel free to get with them. Courtney's put her email, I believe, here in the chat. Correct me if I'm wrong. I'm not reading the chat because there's so much in there. But Courtney will schedule you and get you with Andrew and Derek to dive deeper into how this works for you and potentially your monies. And if anything, we want you to just go in and understand what people are investing in today. You don't necessarily have to work with us at Horizon or with them at Brick and Mortar. I love having new concepts. And I think someone mentioned it a few times. Where are they, are you doing these in other cities? Before you answer that, my opinion is that I assume they're always open to that consideration at some point. But I love it when people are just really good in their markets. And I assume you can probably do quite a few in Chicago. And so, a lot of people, I thought this in my 20s. Oh, if I could do it here, I could do it over here. And I can now buy a hotel and I can do this. And all of a sudden, it was like the operations started falling apart. My profitability went down. Understanding your market and really being good at it is a game changer. And when you start getting distracted because, oh, it worked here, it's going to work there, a lot of times it is a pitfall. and I see people struggle with this all the time. So very, very informative, very good information. Thank you guys. Let's jump over to Claudia. Claudia, a lot of you might know her. If you don't know her, she helps oversee all new business, all new relationships coming in. Welcome, Claudia. How about you give us some questions here before we end in a few minutes and give away a gift here and prepare for tomorrow's 11 o'clock, 2 o'clock
Absolutely.
Eastern.
Yeah. So I have a lot of people asking how long the investment is locked in for.
Sure. So it's the cash out refinance event is right around the years 3 to 4 of the
3 to 4.
investment.
Okay. And
Mhm.
what's the minimum and maximum investment? And do they need to be accredited?
Good questions. So typically our minimum investment is 50,000. Uh, for this group with Greg and his team, we're open to lowering that and reducing that to 25. In terms of being accredited, they don't have to be. We can work with a investment club direction, which is just a vehicle, like Greg had said earlier. It's a container to allow non-accredited investors to participate.
Awesome. Have you raised money for each of the previous locations?
Yes.
Perfect. Is brick and mortar a DST?
Brick and mortar is not a DST.
Perfect. Those are. Can I get a copy of the performa?
Let's schedule a call and
Yeah.
discuss, and then we can run through that. Absolutely.
I would like an appointment, please. So, did we already put in the link to get an appointment? Definitely
Yeah. So,
schedule your guys' appointment. It looks like there's a lot of minimum length, investment length. So, we already went over that. Do I have to be accredited? Minimum 50, we'll lower to 25.
yeah, Courtney is our incredible chief of staff. And so Courtney at victoryground.com, or you can email invest@victoryground.com. And we'd be happy to set up an appointment and go from there.
I
Yeah.
like Peter's question here. Peter, sorry, it's going so fast, so I can't catch them all. But how many projects were to just go? Investors receive their investment back so far, where you did the whole turn. Have you refinanced? Has that happened on a couple projects already?
Yeah, so Park Ridge was the first, and then we're literally doing Deerfield this week. We're working with the appraiser, so there's an appraisal coming out to do the appraisal on the real estate, and then going through that process. So by the next 30 days, that should be wrapped up and moving forward.
Somebody's asking, what are the spaces daily rent, and are there long-term rentals as well?
So it's a mix. So it's hourly, daily, and monthly. So the meeting rooms you can do on an hourly basis, anything from a huddle room or lounge for $35 an hour to a conference room at 55 an hour to a collaboration room at 95 an hour. So you got your small, medium, large from 4, 8 to 20 people. And then there's daily, $35 a day. And then there's memberships based on that with focus stations to sit stand desks, and then private offices where the you can do monthly. I will say our most common term for our private offices is 2 years.
2 years. That's
Did you mention the
great.
virtual office as well, Andrew? I didn't catch that.
Yeah, so our virtual office is actually the most profitable square footage of the space. It's $50 a month, and uh, where anyone can create their own business address, right, for their LLC, for their business. And so we have a lot of attorneys, a lot of entrepreneurs, a lot of investors who ultimately don't want their uh, uh, business mail going to their homes. They want to have a professional address, and so that's $50 a month for that.
Oh, perfect. Okay. What happens when one partner wants out?
So because you'd be on the LLC in an operating agreement, you're able to sell if you'd like, and if there's a buyer for it, but ultimately you're in the deal, you're in the opportunity. Mhm.
Okay. Somebody's asking a specific question. If you're raising, um, I the number doesn't make sense. Maybe you can read it. It's
Yeah,
the
it
last
does.
one in the
Yeah,
chat.
yeah, it does.
Okay.
It's right. A million 50. That is correct. That'd only be
Okay.
21 investors. That is correct. You understand? But I'm sure most of your investors are not most, but a lot are doing 100 or 200,000. So you probably end up in between 5 and 15 investors. Again, that's an assumption because our average investors at Horizon are, 50 to $100,000. So, yeah.
Mhm.
That's right. That is accurate.
It's asking, with an investment like this, what could go wrong that could cause us to lose their investment?
Yeah, great question. And I didn't mention this, so I'm glad whoever asked that. That's the benefit of having real estate backed investments. We have actually quite a few angel investors who come from the tech space, and they transition to working with us because in the tech space, it was either you're hitting a home run or you're getting zeros. And they were looking for ongoing cash flow. And when it's real estate backed, uh, that's your backstop. And so it, the odds of uh, you losing in what we do is we'd have to be, I guess, well, I'll put it in this perspective. Our pro forma would have to be over 50% wrong for us not to break even and be able to pay our 8% to the investors. So worst case scenario from our vantage point, if investors are getting 8%, which is still a respectable return in the marketplace. And that's again us being over 50% wrong.
Awesome. Well, we have a lot of questions that I'm going to roll over to tomorrow, if that's okay, because tomorrow we'll have a lot of time to answer questions. We'll go over key points from today, and then we'll be able to answer
Yeah.
anybody else's questions.
I'll, as you gathered the winner for the chats today. By the way, Arlene will go over your questions tomorrow. Some of the competition, Tom, we can go over that tomorrow, as well as fees, et cetera. I will say for those that want to set up an IRA, we are for this 2 day, it's $495, include your setup and your annual. So if you're on here and you want to schedule an appointment, it's $495 in year one. In year two, it's less. It depends on your asset value, between 25 basis points and 100. So it's 1% or less, basically, every year going in year two forward. So $495 to get started on the self-directed part. And then you can take action and invest in what you want. But we'll go over more details tomorrow. Schedule an appointment. You got the links there. We'll go over your questions as well. Let's give away a gift here for those that were really active. I really appreciate it. A lot of really good positive energy. So I got to watch it while they were talking a little bit. So Claudia, who is the most active here today?
Yes. So our most active listener today was Ramon Connor. So that is going to
Ramon.
be, yes, we'll go ahead and send you your gift card this afternoon, and tune in for tomorrow so that you can win again. You can't
Come tomorrow, 11 o'clock. You
Yeah.
can't, you got a beer to win. You got to play to win. So we'll see you tomorrow, 11 o'clock. You won't want to miss it again. We will answer every single question tomorrow. We will not get off until we answer every single question. So bring on the questions in the comments. We look forward to tomorrow and prepare to, drill Andrew and Derek and all the good things, and me just a little bit. No, but in seriousness, we really appreciate your time today, and look forward to working with you and or helping and educating you. And hopefully this was helpful for you today. So see you tomorrow, 11 a.m. Pacific. Have a great afternoon. Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.